Welcome to the All Financial Hour podcast with Steve All.
Hey, Steve, when is the next stock market crash going to happen and what can I do? Well, studies show that you may see a lot of them over the next 25 years in retirement. They say that a 10% correction happens about once a year. So you may see 20 of those. And a 20% bear market happens once every 4 years. So you may experience about 6 of those. And then declines of 30 to 50%. And although they are rare, we've actually already seen 2 in our lifetime. That's in 2000 and 2008. So, Steve, when it comes to people, losing a little bit, taking that huge drop, do you find that the bigger ones are scary or the smaller ones? Or, how do you help minimize that risk?
Well, that's what we start to look at when we start to look at people's risk reward. Because when I have people call me and they're nervous about what's going on, right now is uncertainty. So everybody's nervous about what's going on over in Iran. What's that going to do? Is that going to cause us to go? If you listen to the news, you can find, everything is going to be terrible. I read one article that said oil was going to be $200 a barrel. And I think
Yikes.
News outlets are created by creating fear. That's what people look to. That's what people listen to. So when we have those people that call in and they say, how are you invested? Now, you hit the big ones there. 10% declines in a market happen almost every year. Those are called corrections. That's when a market gets too high. They don't go straight up. They got to give a little bit back. Bear markets, 20%. About every 4 years to 8 years. We haven't seen a lot of them since 2009, though. So a lot of the younger investors have never seen it really happen. And it's not something they look at. But the fear of those my age that are retiring is the 2000 and the 2008, the dot-com bubble bursting, the financial collapse. Those are what most people are afraid of. And avoiding those types of situations is what everybody is concerned about. But what did it say? Those declines happen. They're very rare. A 30% decline in a 2-year period, it's got about a 2 to 3% chance of happening. Now, if it happens, it's go from there. So how do you protect yourself? I like to look at it. We can go 2 different directions. One, I can go to the investment world and I can look at structured notes. That it's principal protection notes. Those cover, if the market's down, I get a 0. If the market's up, I don't get all of it. And then you could go to the insurance world, a completely different area, and say, I like that fixed indexed annuity. Now, that fixed indexed annuity has a floor of 0. You cannot lose money due to market volatility. But because I have a floor of 0, there's limitations on how much you can make. You got caps, you got spreads, you got participation rates. Sometimes they're not that easy to actually look at. So if you're looking for protected growth, whether you're looking at it in the investment world, there are options for that, or the insurance world, give me a call. Let's look and see how we can protect a portion of your portfolio so that you don't have to worry about the 2000s and the 2008s happening all over again. Give us a call, ask for that risk-reward analysis, and let us look and see how we can help protect the growth of your assets over the last 3 to 5 years.
If you'd like to sit down for this complimentary, no cost, no obligation, by the way, this risk-reward analysis, be one of the first 5 callers right now. That's 636-230-8824. 636-230-8824. And that website, of course, yourmoneymattersstl.com. Now, when you retire, there's a couple things that change, folks, right? You don't have to hit the alarm clock. You don't have to attend those meetings. But the one thing that never changes is that you have bills coming in, right? Things got to get paid. So you're looking for, where's this income coming from? Well, we talked about annuities and how they can serve up as a continuous stream of guaranteed income month after month. But at the end of the year, You got to answer to the tax man. So what are those tax implications for annuities? Well, here's Morningstar's Christine Benz.
It gets a little bit complicated depending on the account that you use to fund the annuity. But generally speaking, you'll obtain some tax deferral as long as the funds are inside the annuity. And then you'll owe taxes on any money that hasn't been taxed yet. So if you put pre-tax dollars into an annuity and it makes investment gains, well, all of your withdrawals will be taxable. And they'll be taxable at your ordinary income tax rate. If you've put in some money that has already been taxed, there's what's called an exclusion ratio, meaning that you won't be taxed on those funds again.
Okay, so Steve, when you're funding annuities for clients here, how do you decide which to use? Tax, pre-tax? I mean, and does it really matter? How big of an influence is that when it comes to making a decision?
I think it's a very big part when we start to look at annuities for income. As Christine put it, if it's in an IRA or your 401k, the traditional side of it, everything that comes out is going to be taxed. If it's after-tax money, your non-qualified assets, those things you get 1099s for, that she's talked about an exclusion ratio. Annuities, the easiest way I can say is non-qualified, last in, first out tax-wise. So the gains, you get taxed on the gains first. So we look at it that way. So now we start to look at which assets did I look at those for. I look at it for if somebody has a very large amount of IRA and 401k dollars. I don't mind using an income annuity for that. Why? Because if the value of the account is down here, but your income is higher, because if we use the 4% rule or anything like that, a small amount would be considered what you're taking out. Well, if you get a withdrawal of 4, 5, 6, sometimes larger percentages from the account, you're making up some of that RMD that you're going to need to take out of that account, and it will continue to shrink, but it's going to be taxable. I'm not a real big fan about putting Roth IRA money into an income-based annuity, unless that's all you have. If you've converted everything else and you need a guaranteed income, I'll look at it, but I would prefer to go a different direction. Somebody that's got a very large amount of after-tax money, we might look at that and say, let's put it in an income stream, because then if you need to take $5,000 a month out to meet your income needs, part of it's the principal you put in and part of it's the income that you have. So not every dollar that you receive is taxed. So that's where you have to start to look at it around income. Taxation is very important, but the idea around it is if you thought about how you're going to replace your paycheck. Say you've got a gap of a couple $1,000s between your pensions, Social Security, all your income's guaranteed, and your expenses are slightly higher. It might make sense to take a portion of your money and actually create that personally funded pension that's going to pay you that paycheck for the rest of your life. And if you choose, it could be for both you and your wife's life. So that's the thing that's good. Other thing that people like about pensions is I'm going to get it every month until I pass away. The thing they don't like is when I die, it goes away. If you prematurely pass with a personally funded pension annuity, the balance of the account will go to your heirs. So there are some advantages on that. So if you haven't thought about how you're going to replace your paycheck in retirement, give us a call. Ask for that income analysis and look at it to the fact of saying, if I need income, where would be the best place for me to take it for taxes in the future?
And again, if you're looking to replace that paycheck, doing this income analysis right here, guys, is key. Again, 636-230-8824. There's no cost, no obligation with that income analysis. 636-230-8824. I'm going to take you back to the 1990s where something changed with the typewritten page. I remember this, actually. Computers came along and gradually killed the so-called rule that said you must have 2 spaces before starting a new sentence. But Texas attorney Jeremy Rosenthal, he says not so much.
When you type a sentence and you put a period, I'm being told that you can only have one space afterwards. And I'm tired of it because you put two spaces after a sentence. White space on a paper attracts your eye. It is two spaces. It's designed for the eyeball. And I'm tired of people saying that only one space. So if you see me in the courthouse, don't talk to me about one space because it's two.
Man, he is putting his foot down there. One space, not two. Crazy.
I guess I didn't realize that rule. I still put two spaces in everything I do. Now, I think I remember once my kids telling me, Dad, you don't have to do that anymore. But that was, to me, was more of a habit. And I never thought about why. But I think Jeremy hit the space will catch your eye. If it's a big old long run-on sentence, you don't stop. And I think it's a lot easier to look at it and say, okay, stop, go to the next one. But I guess I haven't caught up to all the millennials of today and whatever they call the kids that are in college now. I still put two spaces on everything that I have. So thank you, Jeremy, for giving me a great reason when people ask, why do I do that?
Yeah, exactly. Yeah, you can put your foot down just like he did, apparently. And, again, it's a comfortable rule. You get kind of just used to doing it. You don't really think about it. But what if it doesn't necessarily work anymore? I mean, what about some comfortable rules when it comes to money, Steve?
Okay, that's what I would like to call conventional financial wisdom. They're those things that we've heard so often, we just assume them to be true. And I like to use the deal because I think everybody from our generation, M&Ms, they melt in your mouth, not in your
hands.
Now, everybody answers it that way. Is there any truth to that statement?
No.
No, if you put M&Ms in your hand and let them sit there for a while, you're going to have chocolate all over your hands. Mm-hmm. Okay, the other one is, and this is going to really test your age.
Oh, boy.
This is really going to, I would walk a mile for you're too young for this one.
I am. What is this one?
Camel.
A camel, that's right.
You would walk a mile for a camel. Now,
Yes.
most people that smoked that much back then didn't walk miles, so we didn't have to worry about that one. So we look at that. So those are the conventional, but we heard those things so much. So now we hear rules like you need to hold a lot of cash because you need to be safe now that you're retiring. Not as bad of an idea many years ago when life expectancy was in the low 80s. Now that life expectancy is up to 85, 90, when you get to those. Matthew and Molly came in. They had moved everything to cash. They had CDs, money markets. That's all they had. If you're in that situation and we come in today and there's much of a gap between your lifestyle and your expenses, my statement is you may go broke very safely. That might not be the best thing for you to do. So some of those old rules of thumb, 80-20, or the take your age minus 100 gives you these rules. Or this is the big one. Don't worry about taxes. You're going to be in a lower tax bracket in retirement. I ask that question at every presentation that I go to, and I ask how many people are retired, and I get a whole lot of people to raise their hand. And then I said, how many of you are in a lower tax bracket? And almost everybody drops their hands. So that's one of the things that we do have to look at. And I believe that going through those different rules is finding out how much risk should you take for the reward? How are you going to replace your paycheck? And will taxes be a problem for you in retirement? Those are the pillars of financial planning. So what I'm going to ask, if you don't know the answer to all those things, call, ask for that comprehensive retirement plan. Allow myself and my team to look at where you're at so that you're not depending on an old way of thinking that might have worked in the 60s, 70s, and the 80s, but is not as effective today. Give us a call. Ask for that comprehensive retirement plan.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group LLC.
This radio show is intended for information purposes only.